Okay, hi everyone. Good afternoon, good evening, wherever you are in the world. I hope you're doing well. And my name is Richard Perry. I am a market analyst. I'm now working with INFINOX, and we're going to be doing webinars. And I do a lot of research for them on the website. If you go to their research section, you'll see a lot of the articles that I'm writing. And I'm also now doing videos for INFINOX as well. So if you're connected on LinkedIn and other social media channels, then you should be getting some of my daily videos that I do. I've been an analyst for 20 years now, so I've got a lot of experience and mainly use technical analysis, but also now moving in the last sort of 10 years or so. I mean, I was brought up on technical analysis, but in the last 10 years or so, I've also used fundamentals as well, and you sort of bring the two together and it makes a good, well-rounded view of the market. So yes, that's a little bit about me. So one sec, I'll get this presentation going. No, I don't want that at all. Right, okay, so yeah, welcome to the webinar. Before I get going, I'm going to just show you this very brief risk warning. So you need to read that very briefly, because I'm going to be talking about live market information. So just understand that it does nothing that I say is constituting investment advice. That is the important thing to say, basically. Okay, so what we're going to do today is we're going to look through a few of the key events that you need to watch out for in the coming month. Look at the big picture on the macro side, then look at Forex, look at commodities, indices, and then throughout the presentation, if you have any issues that I haven't explained correctly, or there's something you want to know in a bit better detail, put it into the Q&A, and we'll do our best to sift through any questions that arise, and hopefully then I can answer them in the Q&A section towards the end. So getting into it, right, okay, so things to look out for in April. We're always on central bank watch, but April is a bit of a quiet month for central banks until the end, really. And even then, the end, you've got the ECB, the FOMC meetings for the European Central Bank and the Federal Reserve. They're not expected to be meetings that do a great deal. They are meetings that haven't got the economic projections. We've just had those meetings in the last round. So you tend to get less action in those meetings that you don't get the economic projections. And it will be sort of a little bit of a sort of steady as she goes type of affair, I think, towards the end of that, end of the month there. And you've also got the Bank of Japan on the 27th of April as well. Again, nothing really to expect from the Bank of Japan that creates any real surprises. And finally, the Bank of England. We have not got a Bank of England meeting this month. So pretty much in the next slide, I'll talk about macro events, but pretty much we're looking at how the speakers of these central banks can guide the markets through their speeches, basically, and that could be something we need to look out for. Third wave of COVID in Europe is a big factor, potentially. How does Europe really respond to this rising rates of infections and hospitalizations is going to be the key. How big does that get? News flow surrounding that will be important. How do the lockdowns go? Do the lockdowns really affect the recovery potential of Europe? And increasingly as well, obviously we're getting the political aspect of vaccines in this spat between the Eurozone, or the EU, I should say, and other vaccine partners, I suppose you'd call them. The UK is in the brunt of it at the moment, but yeah, how does that really pan out for the Eurozone and the EU? We're also looking at something that's cropped up actually in the news in the last couple of days, which is that Joe Biden, the US president, is sort of considering even more spending. I mean, there's been 1.9 trillion already, obviously, in the latest round of spending from the COVID relief. And he's looking at spending another $3 trillion. What effect that is going to have on markets as the news flow comes out of that. So they are the sort of key areas that I'm looking out for in the coming month. So in terms of the macro factors, oh, but by the way, if you miss anything that I'm talking about on these slides and you need to see that slide again, what we're going to do is I've sent the slides out to the INFINOX guys and the marketing team. I think are going to be sending those slides on to you. So that's going to be something that you're going to be getting, I think, in the post webinar care package. We'll call it care package, why not? In that you'll get the slides and you'll get, I think, a recording of the webinar as well if you need it. If I've not covered something or you've missed something, maybe you'll be getting it in that. So yeah, okay, so macro factors that we're going to be looking at. Big one, how does the US economy bounce back in Q2? The economics, the signals are suggesting that the US is going to be in a good position to recover. I've got here the PMI data and the regional Fed surveys. PMI data has picked up. Certainly, the ISM, the market PMI data has picked up. But look at these Fed surveys. Now, the Fed surveys, or the regional Fed surveys, I should say, give a good indication of how the US economy is starting to develop on a regional basis. And when these Fed surveys start to pick up, that would suggest that economic activity is really starting to get going again. And you can see that in the last sort of couple of months, really, they've started to all go in the positive direction on these Fed surveys. And that is a positive coming out further down the line, you would think, for the US economy. So good signs there. However, the question mark, I'm not going to focus on it too much, but the question mark would be, how do US bond yields react to this? Now, I'm not going to focus too much on this because it's something that I don't want to sort of hark on about too much, because but it is something that is important. So we need to have an eye, at least keep an eye on how US bond yields are going. And if I show you this chart here, you can see that the US 10-year yield has been rising sharply. And basically the takeaway from this is when US yields rise really quickly, it gives market increased fear that this rise in yields are going to drive a big bond market sell-off, and bond market sell-offs are the last things that people need if they're done in a disorderly fashion. So that's why through February, beginning of February up into middle of March, we saw that the dollar has been strengthening quite a lot, and you can see here the dollar has picked up and again continues to rise quite sharply. This is the dollar index, and the reason being that the dollar is seen as a real safe haven play, and rising yields, the dollar has been focused on as the one asset outside the bond markets that the traders will be looking at for buying, I think, because subsequently we see that a lot of the correlations that we've got at the moment are dollar positive correlations, and positive for the dollar. And what you can see here on dollar index is that the dollar is expected to continue to rise. Now, if I show you this chart, this is the long-term chart of the dollar index. You can see that this improvement in the dollar index has really gone. That was 2020, a big sell-off on the US dollar through 2020. You might ask the question, why? Well, markets were thinking, look at all this fiscal spending, look at all this monetary policy, monetary easing that you've got. Risk appetite was going well. Equity markets went gangbusters. The dollar was not a good option for traders because of the safe haven aspect of the dollar. However, as treasury yields have started to really pick up, that has scared traders to an extent, and we can see that the traders have moved into the dollar as a safe haven play. You can see this recovery that we've got on the dollar, and I think that recovery is going to continue for now. I think that this has the potential to possibly even come towards 94 to 95 area, and you can see here on this chart long-term resistance band 94.50 to 96. I think that we could be seeing 94.50 area, maybe 94 to 94.50. And certainly moves in the last few days have suggested that that could be the case. It's gone a little bit high, you could argue. It's got a little bit of ahead of itself. Maybe it's a bit overbought near term, the dollar. You might get a bit of a near term kickback, and I'm going to show you some of the charts that would reflect that. But I still see further room for a dollar increase, and the dollar strengthening would mean charts, and I'm going to talk you through some of these charts in a bit. Dollar strengthening would mean euro dollar going lower. It would mean charts such as Australian versus the US dollar going lower. It would mean the New Zealand dollar versus the dollar going lower. Charts such as that. So this is something that is a real issue potentially. Goodness me, the seagulls. Sorry about that. It is something that certainly has the power to impact through major markets, and I'll show you some of the correlations that the dollar has with assets such as gold and treasury yields and equities as well. Important there. So dollar going up. So that's again a reflection of where we're at. So in terms of oh yeah, the 10-year treasury yield, could it reach 2%? 2% is considered to be a likely area for the 10-year treasury yield. So I'm just going to 1 sec. Sorry about that, seagulls. It was hopefully not disturbing you too much, but they're gone now. Right, so yeah, third wave of COVID in Europe. We need to be looking out for how this really does develop, and I've got a couple of images here. First of all, reflecting this third wave of COVID, let me just zoom in that a little bit. And you can see, right, UK down at the bottom, no real sign yet, and I repeat this, yet, of a third wave of COVID. However, look at France, Italy, Germany coming up. Not yet really in Spain either, but Germany, France, and Italy, three of the really big Eurozone nations having to go into lockdown as the third wave of infections really starts to hit. Now, one of the factors behind that is this chart here. Again, zoom in slightly better. You can see here, vaccine rollout. Look at the Eurozone vaccine rollout, very slow and steady. And even then, in the last few weeks, tailing off. AstraZeneca issues, probably something to do with that, I would imagine. They should now start to pick up. Now AstraZeneca has been deemed to be okay on the vaccines, but look at the UK rate going gangbusters there, and that is one of the reasons why we're expecting to see sterling outperform euro. Is purely on the vaccination, is because the vaccination rollout has been such a success. I mean, through 2020, you could certainly put a lot of criticism at the government's front door about how they handled the COVID-19 crisis. However, vaccine rollout absolutely has gone superbly. So that is a positive for the UK. It sets the UK up for what should hopefully be, if there is an uptick in infection rates for in inverted commas third wave, you'd think and hope for the UK it wouldn't be too bad. And it does mean that the UK should be able to reopen their economy quicker and put to work all that pent-up savings that supposedly is £150 billion, according to Andy Haldane of the Bank of England. So that's a good thing. So that's one of the reasons why we're expecting to see sterling outperform euro, is this chart here. And as I said earlier, major central bank developments, FOMC and ECB meetings at the end of the month, so not expected to do much, but the Fed speakers are important. Fed speakers have already impacted on the dollar in the last couple of days. We had comments from Robert Kaplan of the Federal Reserve, and also we've had comments from James Bullard. Both of those comments, Robert Kaplan was talking about raising rates in 2022. That is certainly sooner than the market was expecting. And also James Bullard was talking about tapering asset purchases possibly this year. So two factors there, which were pretty hawkish for the Federal Reserve comments. Now, obviously, they are just two members on a voting committee. And we're not sort of focusing too much on that, but certainly it does give an indication that some of the Fed members might, as this year rolls on, start to get more hawkish, and subsequently we could start to see the rolling back or the tapering of asset purchases at some stage towards the end of the year, maybe early next year. And that could again help to certainly support the dollar if we get more Federal Reserve speakers in the coming weeks talking about that. So that's something we need to keep an eye on. That is certainly from the central bank perspective. And finally, looking down here, you've got again the more fiscal spending from Joe Biden's administration. Now, the Federal Reserve has increased its expectations of growth in 2021 from 4.2%, I think, to 6.5%, pretty much just down to the massive 1.9 trillion of spending that the government have put through. So big spending from the Biden administration there. They're looking at possibly another, on top of that, 3 trillion of spending at some stage. Now, my goodness me, this is huge amounts of money. 1 trillion of that is expected to be infrastructure costs, infrastructure spending. Again, that would be helping sort of roads, bridges, railways, all these infrastructure factors that help to create jobs. A lot of jobs still, I think 9.5 million jobs still yet to be filled in the US. So that could help certainly towards that. So this is all positive for the US economy, again, further down the line. And ultimately positive risk appetite, but $3 trillion, what does that mean for the reflation trade and bond yields as well? Again, we're not going to focus too much on that, but more fiscal spending, the government needing, government spending more help to raise bond yields, and risk appetite is positive on that. But if bond yields go too fast, too quickly, then we get a little bit less positive on that front. Okie dokie. Let's look at Forex now. Okay. So what are we looking at on Forex markets? Well, okay, dollar strengthening. As I said, I continue to think that the dollar will be strengthening, and the dollar is correlated still with treasury yields. And what I'm going to show you, I'm going to show you a few charts which reflect this. I'm also going to be looking at some MT4 charts of the pairs, but I've got my correlation charts that we're looking at here. And what you can see here is that the dollar at the moment, and this is, you can see in 2021, as bond yields have shot higher, the dollar has also shot higher. This is a correlation chart, and you can see that tends to be that the dollar and US 10-year treasury yield are positively correlated. So when the treasury yield is going up, so is the dollar, and that is one of the drivers behind the dollar index going higher at the moment. Little bit of a tailing off in that correlation in the last day or so, as the dollar has continued to go up, even as treasury yields have gone down. But I would be more worried if that correlation was going down because treasury yields were going up and the dollar was going down. Now, the opposite is actually happening. So I continue to think that treasury yields are going to be going higher 1.8, possibly 2%. And I think that that continues to drive that dollar index chart higher. So that is one of the factors we're looking at, dollar strengthening to continue. I also think euro is going to struggle through that through the coming weeks, certainly in April. I think the euro is going to continue to struggle with not only dollar strengthening, but also this third wave of COVID is a factor there. We also see if the dollar is rising and markets are a little bit less risk positive, that is going to have a negative effect on the Aussie and the Kiwi. And we've seen, we're starting to see that coming through. And I'm going to, as I said, I'm going to show you some of these charts in a minute. Furthermore, we may well also start to see that the yen strengthens. And one of the charts I showed in my videos the other day was Aussie versus the yen on the cross, Aussie yen cross. And that has started to come lower. And that Australian dollar versus the Japanese yen is a really good indication of how risk appetite is going. When Aussie yen goes up, that means the Australian dollar is strengthening versus the yen. The Aussie is considered to be a higher risk Forex. The yen is considered to be very much a safe haven. So when the Aussie yen's going up, that would tend to come when traders across asset classes are tending to be risk positive. However, that is starting to reverse. So I'm going to show you that chart as well. And sterling, yeah, this is an interesting one. Does sterling start to... Sterling has been falling with the dollar strengthening. So cable has been falling, but I still look at cable weakness as a chance to buy. So we've got some interesting options, I think, here. So let's have a look on the MT4 platform. First of all, we're looking at the euro-dollar chart. And we can see that euro-dollar has been breaking down pretty much ever since the year kicked in, 2021. Ever since that pretty much took off, euro-dollar has been corrective. Lower highs, lower lows, and you can see old resistance, if I can say it, old resistance becomes new support on the breakdown. So that would suggest that we're starting to now get into a realm, another big negative candle today. So you'd start to think of whether this area here is going to be an area of resistance. This old support becomes new resistance. So on a rebound, we start to think of whether that that reaction low, let me get the crosshair on it. Reaction low coming in around 1835 up towards 1875. Is that now going to be a resistance area and a possible sell zone on a rebound? What we have is negatively configured momentum on the RSI, little bit coming towards an area where the rebounds have kicked in. So this might be a bit of a timing issue for selling euro dollar, but I still think euro dollar has got downside to go. And if I zoom back out again, I think it's going to be coming back toward these lows of September, October time, around the 16 big figure area. And looking at a couple of other indicators as well, you can see that this is stochastics. I've got stochastics and Bollinger Bands here for euro-dollar. I think these are falling away. So again, we're looking corrective. Again, around that, that's the 20 Is the sound back in now? It should be. I think it is, yeah. Sorry, I don't know what happened there. I don't know how that happened or what happened. But anyway, sorry about that. Yeah, should be fine. Sorry, everyone. I hope that wasn't. I hope I wasn't out for too long there. Thank you. Thank you very much. Right. Okay. So yeah, I think any sort of rebound towards that 20-day. This is the Bollinger Band. Any rebound towards that Bollinger Band middle line, which is the 20-day moving average, is a selling opportunity. Again, stochastics looking negative, very near term, possible further downside. But again, would you be selling now, or would you be selling into a rebound? I would say probably better to sell into a rebound, but certainly the momentum is negative near term. You can also look at the MACD lines, again, very negative at the moment. So I'd be more comfortable selling into strength is what I would say. But if you were, I mean, that's what I would be looking at. I'd be selling into strength. But the downside that we've seen in terms of the breakdown certainly gives you, yeah, that a feeling that this is going lower for now. So let's have a look at cable. Again, long term, big uptrend on cable. Let me just, we are quite zoomed out there, but you can see that this big uptrend has now been broken on cable. Big decisive move lower. And that has come through some support lines. We've broken below this moving average, which is 55-day moving average. 55-day moving average would tend to be seen as a sort of a medium-term indicator, a medium-term trend indicator. So below that means you're turning negative. Look at the relative strength index, the RSI, looks negatively configured, and it looks as though its downside move, I think, will be coming. But ultimately, I think because of the fundamentals will kick in at some stage where traders will see sterling as having good value, I think, in the fact that you've got this economy reopening. And I think that will be kicking in. And maybe the trade to take would still be downside on euro sterling. So maybe playing sterling versus the euro rather than cable, which is sterling dollar at the moment. But I would still say my outlook is still that I think you're going to get sterling moving towards 140 in due course, but the timing of that move, whether you get further downside on the dollar strengthening at the moment, is difficult. It's interesting today, I've noticed that the dollar is stronger pretty much across the board, apart from against sterling. Is that still the case? Sterling 49 pips up. So yeah, dollar is stronger again across everything apart from sterling today. So sterling still has the ability, I think, to be an outperformer. And actually, as I say that, let's have a look at my rebasing chart. And these are the currencies. Gold at the bottom. Wow. But also still looking at the safe havens underperforming. This orange line, which is the yen, and the silver line, which is the Swiss franc. We've got euro falling away sharply. Look at how the Aussie and the Kiwi have fallen away. They were really strong, Aussie and Kiwi, the two blue lines here. They've fallen sharply. This is year to date, actually, performance against the dollar. You can see that the Aussie and the Kiwi have really fallen sharply. Two lines up the top, outperforming sterling and the Canadian dollar, two outperformers. So that continues to be the case throughout year to date, that is. So I'd still say that that's likely to continue in our opinion. So sterling, downside move. Let's have a quick look at stochastics on sterling. Little bit stretched, maybe starting to pick up on the stochastics, possibly, but yeah, maybe some further downside. And in MACD, again, actually having just turned negative. Look at that cross actually on the MACD lines as the bars go negative. Yeah, mixed signals, I would say, from cable, but I think ultimately sterling will be a buying opportunity. Now I'm going to look at Aussie and Kiwi, because these are two that I think have the potential to be really significant. I mean, look at that. Okay, so let's just zoom in one more. You can see this big top pattern, big head and shoulders top pattern. Anyone who likes their pattern analysis, that is a big head and shoulders top pattern, and it would complete on a move below 75.63. Just trying to get my line right. 75.63. That is a big move. And look at the momentum, the RSI, the relative strength index, failing every time at 50 now and moving lower. This looks like it's a market that's about to turn a bit nasty, actually. Look at these moving averages. That is a death cross on the this here, where the 21-day moving average falls below a falling 55-day moving average, is your definition of certainly a near-term death cross. That does not look good for the outlook on the near to medium term basis. And again, if you break below that 75.60 level, that is Aussie dollar moving lower. So watch out for that. We're also looking out for Kiwi as well. This is Kiwi, already has topped out. Similar move, top pattern. I showed you this in the videos that I did. I think they did this on, I think it was Monday this week. Again, big change in outlook on the Kiwi, and it's fallen below 70 big figure, big support line broken. So if you zoom in here, you can see that was an old level of support, 70 big figure, 70.95 completed the top pattern. This becomes an area now of resistance. So this old support becomes new resistance on a breakdown. You've got these momentum indicators. Look at that throughout pretty much since October. Strong momentum higher as the Kiwi ran up towards that level up at the top just a month or so ago. But since then, it's really fallen hard, and momentum has really turned negative against the Kiwi. So something there to be worried about, I think, if you're looking long of Kiwi. So there's selling opportunities I'm looking at between 70 and 70.95, which is now resistance. And I talked about Aussie Kiwi as well. Sorry, Aussie yen. Breaking an uptrend. It hasn't yet really given any sell signals. The only corrective signal you could sort of point towards is this negative divergence on the RSI. This lower high on the RSI is a negative divergence. Negative divergence shows that momentum has shifted towards a more negative line. In terms of positive momentum turning less positive, and possible top patterns are quite often seen with negative divergence. So you zoom in here, and what are we looking at for? Well, this line of support, which is 81.89, if that gets broken, that completes a double top pattern, and you'd be certainly calculating probably 4 big figures down. Sorry, 3 big figures down. 3 big figures, my mistake. So you'd be looking at a move below 80, maybe even 79 area. And 79 area is basically this old band here of the January trading area. And again, that would be a real signal for me that sentiment is turning corrective. And what would possibly drive that? A sharp move up in US bond yields would be something that I'd be looking out for. Right, let's back on that. Yeah, I think I've covered all that. So yeah, again, if you want to see that, we'll send you the slides and you can have a look when in your own time. Commodities, right? Again, it's really interesting that US Treasury yields, the rise in US Treasury yields, are a big factor across markets. And it has certainly started to spook markets in recent days. And it's interesting that we're starting to see that gold wasn't positively correlated previously with the dollar and US Treasury was going higher. It now is starting to be correlated. And that is because gold is still seen as a safe haven play. Until recently, gold has not really been seen as an option because, where am I looking? Gold. So I've got to find it now. golden yields. There you go. So I just had to find that chart. Okay, this is over the course of the past year. You can see that the gold has been under pressure and treasury yields have been rising. And now we're starting to see a big swing up, just in the last couple of weeks, actually, big swing up in this correlation. Previously, during that run higher on bond yields, gold has been falling. Question marks around as to whether that is now going to be the case. As I said, sharp rise in bond yields, markets get a bit scared. Scared markets tend to go into gold and the dollar, but also gold. And it's interesting, I'm going to also show you that gold positively, again, this is gold correlated with the dollar. Again, dollar moving up. Gold has also been moving up in the last week or so, and that again has helped to start to move this correlation less negative. And I say less negative because you can see consistently since July, gold and the dollar, gold have been very negatively correlated. Still negatively correlated at minus 0.4, but less so than it was previously. So gold is starting to possibly find a bit of support. And I'm going to show you some other charts very quickly. So slightly tight for time. I'll show you these charts anyway. This is gold on a weekly basis. Let me just make that bigger. Gold on a weekly basis has retreated to an uptrend on the gold price there on a weekly basis. Uptrend coming in, where is that? Around about 1675. Bounced off that. Keep that in mind because, sorry, not that one. Gold priced in euros has also found support at an old all-time high, 1407. Gold priced in sterling has also found support recently at an old all-time high of 1209. So is this a point at which we start to see the gold price finding support? Well, I think that it's possible. It is possible that we've seen the low in gold. And I'm not saying that we're not going to come back and retreat back towards it, but it's interesting because I think that some of the signs are suggesting that this big sell-off that we've had in gold may just now be starting to slow. We might not have quite seen the low, but it's something that I'm beginning to look at. And in the webinar next month, again, I'll revisit these charts and see how this is going. But this is interesting. I think that we're starting to see some support coming in for gold as the safe haven, possible safe haven option. So look out for possibility of gold. Gold is no longer seemingly selling off sharply as it previously was. So is it beginning to form support? Another factor I'm looking at is oil. I did a big report on oil in today's report on the website on oil. There was a big, anyone who's been watching the news will know that there's this big Suez Canal blockage that has meant that oil price actually spiked 6% higher yesterday. Is that a selling opportunity though? I'm looking at that as a possible selling opportunity. I'll show you the MT4 chart in a bit, but I'm still seeing that that is a possible selling opportunity. And also, yeah, and, so let's have a look at these charts on MT4. And we've got gold, hour one, don't want an hourly chart. Okay, so are we starting to see gold finding support? Again, old support line coming in on gold around that 1675 area. Now let's zoom back in, because not only that, is this a downtrend channel? Well, you'd say that it is, arguably, but yeah, it's not great in my opinion anymore. I'd say it's probably more than likely that it was broken there in terms of the downtrend channel. And also, how does gold now respond around this resistance is the key question. 1750 area, 1740 to 1760 is a massive, massive resistance for gold, in my opinion. If you start to see gold trading through that, above that resistance, I think that that is a strong signal to suggest that gold is on a recovery. At the moment, and I stress this at the moment, gold on the relative strength index is not yet showing decisive recovery mode. Above 50 on gold on the RSI would be recovery mode. So I'd be looking out for that. But it's interesting that gold has not really done a great deal actually in the course of the past 2 weeks. We've still seen the dollar shooting higher, but gold is no longer selling off with that strong rally in the dollar. Previously, as I said, gold and the dollar really negatively correlated, seemingly not so much now. So that's interesting for me. I'm looking at possibility of gold starting to find support. And as I said, if you see the RSI on gold above 50, which hasn't happened for a while, is that a signal that we're starting to see a turnaround on gold? Not yet, but it's something that I'm looking out for in the next month. And oil. Oil, sharp move, big volatility in the last few days. That was the candlestick yesterday was the move on oil where we saw the blockade, big news coming in. Question is that a selling opportunity? I think it is near term. I think there is more to come to the downside on oil. One of the factors I'm looking at is the technicals here. Look at this RSI. Previously above 50, consistently above 50, even towards 55, pretty much consistently throughout this run higher. But what we have now seen, we've seen the uptrend broken, tick number one. This is for possibility of a correction. Uptrend broken. We've seen the breakdown of a key higher low, and that was at 62.20 area. And we've also seen the RSI, the relative strength index, now moving below 50. So that's moving into a more corrective outlook. So that is the possibility now developing that oil could be moving in a near-term corrective move to the downside. And the failure, the fact that the market rallied 6% yesterday and fell over again today gives me the suggestion that it is not in a good way. Oil 4.8% down. You can see here down the bottom, 4.8% down today. So that is not a great reaction. If that was going to be a move, say for example 6% higher, and that was going to be a move that was accepted by the market, that would have continued to go higher. But it's not obviously seen as a buying opportunity, it's seen as a selling opportunity. So that suggests to me that we've got further downside. I think into the mid-50s on Brent crude is possible. And just finally looking at indices quickly, what are we looking at? Again, sort of not to harp on about it too much. US bond yields continue to go high. It leaves markets worried, basically. Leaves markets worried when US bond yields go sharply higher. And I'm going to show you one of the things that I've noticed. Again, moving on to our rebasing charts. Is it this one? No, that's commodities. Is it this one? Yes, right. This is your indices. Now, the purple one is the one that I am really interested on this. This is NASDAQ. Now, NASDAQ is considered to be massively risk positive. If NASDAQ's going up, it's because the whole world is putting money into US tech. Brilliant. But US tech doesn't yield anything, and it's massively overvalued. So the fact that now NASDAQ's gone from being the best performer back in mid-Feb to the worst performer now, and it's now only up 0.3% on the year. You can see that that actually is one of the reasons why the S&P 500 is, which is I think 40% weighted in tech, likes of Apple, Facebook, Google, weighing Tesla, right, massively weighted in those stocks. So that drags the S&P 500 lower. So that's a concern for me. And that is one of the reasons why we're, I think, going to still continue. If you continue to see bond yields going up, I think you're going to continue to see NASDAQ underperforming as it has done on that chart there. And I think that is something that we need to look out for. DAX DAX has no tech weighting whatsoever, I believe, or is it really, or is SAP in the DAX? I can't remember. Virtually nothing to do with tech at all, and subsequently DAX is well, up until recently it was up at its all-time high. Let's have a look. Still basically is all-time high territory. So DAX has barely been impacted by this. So the S&P 500 has been dragged. Where is it? Here we go. Dragged lower. What's this 4-hour chart? Let's get on daily chart. Not much, mind you. I'll be honest with you, not much, but still has been dragged. And I think that is something that we may start to see happening. That this, if bond yields continue to do what they're doing, then we could see that equity markets, the big bull run on equity markets, just stalls. And I'm looking at the levels on the S&P 500. Old breakout levels become supportive. You've just dipped into that these two breakout levels. This first purple band of support being bought actually, but you wouldn't be looking at these momentum indicator on the RSI and think that's all that great. That's more ranging for me. Between 40 and 60 is ranging for the S&P 500. So it doesn't fill me with a great deal of confidence that the S&P 500 is going to burst to all-time highs again. And just finally on FTSE, which again, that's not the chart I want to see. FTSE just ranging. It is ranging. And I will zoom out and you'll see the ranging basically between this old band of support, which is 6250 to 6370, up towards that high, which was crosshair 6960. But I think latterly it's just ranging. It's going to be ranging 68 down to 6350. And it seems to be that in the middle of that range, there's this band of support. Oh, crikey, what's happened there? Yeah, band of support. I think it's going to trade around that. It's interesting that it's dipped into that today and bounced. So maybe it's still relatively positive. But again, looking at these momentum indicators, RSI between 40 and 60 for the past 2 months, that does not fill me with a great deal of sense that we're going to be breaking out anytime soon. So, right. I am now at your disposal for question and answer session. If anyone's got any questions that they would like to have answered, if I haven't covered anything that you're trading, any ideas that you've got that you want me to think about, and maybe try and explain through for you, things like that. Just anything that you find interesting at the moment, I'll be happy to go through.